Nikhil Shamapant.
Nikhil Shamapant. I'm talking to Nikhil Shamapant, who put out an amazing banger of a paper called Ethereum, the Triple Halving, how Ethereum can achieve $150,000 by 2023, and a plea for Ethereum bulls to dream bigger dreams. Wow, what a title. I feel like your aspiration was to write an institutional grade paper, and I feel like I'm reading a like super prestigious sell side report. So congratulations.
Thanks so much. That means a lot.
Nikhil, just give us a little background about yourself. You came out like anon on Twitter, now kind of de-anon. What's your real life about? How did you get this much expertise in kind of analyzing the financial markets and in crypto as well?
Yeah, I mean, my background so far is in medicine. I'm just finishing up my last year of medical school. So not connected to investing at all. And that's why I'm pretty clear about that in my like Twitter bio and in introducing the piece, that I really do consider myself, a retail investor. And I'm aware that there might be errors that an institutional grade researcher wouldn't make. So I've been looking forward to hearing back from people. But my background for investing, I started to get into the stock market when I was 15. I don't even know how I got into it. I think I realized that Google Finance was showing you like stock tickers moving, and that in class, instead of listening to like the history, teacher say something about, old people, I would just look at like, oh, like what's happening to like Cisco stock and like, why is it moving? And
what was the first stock you bought?
Super boring. It was KKR Financial Holdings, and it didn't move. And I sold it for like basically no change. And I decided I wanted something more exciting. And so the second stock I bought was this speculative stem cell pharma company that proceeded to crash 80% in the next 3 months. so that was my introduction.
Well acclimated with shitcoins right out the gate.
Oh yeah. I was like, oh gosh. My dad was like, this is a learning lesson for you in the future. And I was like, oh gosh, yeah.
And how did you learn like finance and investing to the level such that you could write this paper?
Yeah, I mean, initially I was just a high schooler who wanted to like figure something out. And so I had lots of genius ideas that everyone has that don't actually work. So I was like, oh, stocks give a dividend. Like, what if I buy a stock right before it, pays a dividend and sell it the next day? And I didn't realize like these kinds of arbitrage ideas are just like very casual, and like hedge funds will look at this and model them. And if there was an edge there, like it's gone now. And but I was that kind of obsession where I would be like, I have this idea, like I can solve this problem. I can screen for stocks that are cheap before I knew what the value factor was. I then realized everyone else is doing it, and I would just explore. And I started with value investing because I think like a lot of people start there because it just makes sense to them, and I could understand it. And so I learned to read financial statements, learned to value companies.
Was this school or college by now?
High school, early college. And then honestly, like the last couple of years of college, last 2 years of college, first 2 years of medical school, I took a pretty big step back. I just was focused on medical school and focused on studying philosophy in college, growing. And, but then, when COVID hit, I think a lot of people had a lot of time, and I'm sure you saw a lot of people were, playing around on Robinhood when stocks started to resurge. And I knew just enough to kind of not want to make the same mistakes that a lot of people were making. Like I just could not YOLO into a random stock if I knew how to analyze the business, if I knew how to ground myself in what it was worth. So when COVID was happening, I was on the medicine wards and I kind of saw what was happening. So I actually bought VIX call options as that was happening. And I knew just enough to know that the VIX was definitely going to spike, but not enough to know the degree of detail that I know now. Like I wonder now if I would have still had the guts to buy it, because I didn't know about the volatility of volatility. I didn't know that the VIX had a term structure. I didn't, so I just knew, I was like, look, if this pandemic is real, the VIX will spike. And so I bought that call option. And when that worked and we had a lot of time and people got into stocks, I was like, wait a second, let me learn more about this. And so I kind of tapped into that high school energy and I started learning about options and volatility. And I also started learning about Bitcoin because this was April 2020 and Bitcoin was about to go to a halving event.
You're fairly new to the crypto side.
Incredibly new. And so, the cool thing about Bitcoin is in order to get into Bitcoin, you have to get into monetary policy, which if you're learning about value investing, it's just not something that was part of my like high school learning curve. So a lot of people were learning to YOLO these stocks. And I was like, look, I did that in high school and it didn't work very well. So I'm going to learn something else. And so the past like 12 months, fourth year medical school, thankfully is a lot lighter than the other years. And I had time. So the last 12 months, I just devoured content ranging from macro policy to crypto to options and quant. And it was just so much fun. And I tried to put it all together in the Ethereum piece.
How many times have you contemplated dropping out of medical school to do this as a full-time thing?
Yeah, everyone's been asking me about that. And I appreciate the compliment, but in high school, the only thing I considered outside of medicine when people would be like, well, what are you interested in? I'd be like, well, like maybe I'll go to business school. Maybe I'll go be a hedge fund manager. But I think, medicine is great. It's like hard to explain to people who are in finance who are like never considered being a doctor. I'm like, well, it's a whole other side of the world here. And as far as learning too, it's hard to, I guess, communicate, but I think, finance definitely trains a certain part of your brain. It's like very analytical and markets are reflexive. So you can't just think like a normal scientist. You have to assume that what you're going to find out to be true right now using the same methods might yield a different answer 5 minutes later. And that's just really like just an amount of rigor that you don't get anywhere else.
Yep.
But like in medicine, there are so many skills and that you learn that you just are not going to get in finance. Just putting aside the fact, I think that obviously there's incredible fulfillment, just taking care of patients and being a part of like the medical community. There's also like medicine is just messy and people are sick and things just don't go your way and you have to deal with emotions in a way. Like if you think trading psychology is hard, like talk about like, the emotions that people are having when their loved ones are really ill. And so, you learning to take risks in finance is one thing when you can kind of distance yourself. You can't distance yourself from the risks you take when you're deciding what medications to give a patient and things like that. And so I've only observed that stuff as a medical student to this point, but starting residency in 2 months. And I just think, again, it's like this last 12 months, I've learned so many new things. And I think that's just going to pale in comparison to what I'm going to learn this next year. So I haven't thought about it that much, honestly.
That's amazing. What is something that you learned? Have you ever learned anything from the medical side that's helped you or like augmented the way you think when you're on kind of investing in crypto?
That's a good question. Intuitively, so the first rule of medicine is like do no harm, and I know like when I learned about value investing initially, Warren Buffett has his first rule, which is like, don't lose money. And it's easy to just kind of like paper over that. But I remember thinking about that a lot in the last year because I was reading, I don't know if you've read any Nassim Taleb stuff, like Black Swan and stuff like that. And he talks about ergodicity a little bit, which is just this concept that if something seems like it's like a good bet, that doesn't mean you should take it. You have to figure out whether you will be able to survive. And I was thinking about it and I was like, I think in medicine, that's just implicit. Like you can't say like, oh, like this decision is just going to have like a good expected value, but you could just die. Like you have to pause and really, it's baked into how you think about decision-making and clinical thinking. It's just,
so thinking about the tail risk is like by default, whereas in investing, you kind of almost often just neglect it.
Yeah, you have to. I mean, for every it's institutionalized in some ways, and we hate that sometimes. Where it's you have to tell patients that very benign procedures could kill them, and you're like, this is not going to kill them, but you have to tell them that. But it makes sense, right? Because ethically, like tail risk is for in medicine, tail risk is an ethical concern, right? Like if it's more than just I can say no one else saw this black swan coming. Like no, you're the doctor. You should have seen that this could have happened. You didn't need to change. You don't need to make a different decision, but you have to communicate that bad things happen. And yeah, and this is what I kind of was getting at with like medicine is messy and finance is like it gives you a certain amount of distance that you can't get in medicine, and you kind of like don't want in medicine almost. I mean, there's obviously some amount of complexity to that, and I think I'm going to learn a lot about what that really means. I'm speaking to you right now as if I have so much experience. I like talking about my clinical rotations, so I'm like really observing doctors more than being one. But yeah, I mean, just a lot to look forward to. And I think, yeah, I've learned so much about, and a lot of those like softer skills about how to deal with adversity and things like that too.
That's wonderful. I'm so glad you're staying in medicine and isn't just dropping out like the rest of humanity, value add degrees like medicine and engineering to be a finance person. I keep thinking there's a line in Interstellar which is like, we didn't run out of televisions, we ran out of food. Like, man, humanity is like, we're not running out of finance people, running out of engineers and doctors. So on behalf of whoever I can represent, thank you for staying in and still having fun on the side.
Appreciate it.
Let's talk about your paper, because there's so much to go through. Where do we begin? I guess here I'll give you my thoughts. I've read probably 80% of it because it's so epic. But in investing, very broadly, there are two kind of styles you can use when choosing to buy or trade a stock, right? You can go with fundamental research, which is like, how many units of iPhones is Apple going to ship this year, or how many MAUs is Google going to have? You can look at fundamentals and project revenues, and then try to apply a fair valuation to that. And then you have the kind of call it quantitative perspective, which is you could almost, if you were using a technical analysis, you could almost know nothing about the underlying. It could be wood, it could be Apple, it could be Ethereum, and you don't even need to know. You just have to look at the charts and some indicators. You can just trade purely off that. You don't even care what the underlying is. And those are the two primary kind of mental models I've become accustomed to, at least, and most people are accustomed to. But what you're introducing, and maybe it's a subset of the quantitative side, and I'm curious if you think it is, but it's a flows-based analysis, which is sort of like in between, which is kind of like not saying what is this company about, or this token protocol about, what is it going to do? Is it going to be is it going to capture 1% of the banking industry? Nor is it about looking at charts, but rather it's asking what are some natural forces or like inexorable forces that's coming into play that will force market participants to buy or sell or hold in a certain way that has nothing to do with the underlying mechanic, like product or the chart per se. Like, would you consider this a third kind of large mental model of evaluating kind of investment decisions? Do you think it's part of the maybe quantitative side? How do you think about it?
Yeah, I actually, so I agree. That's how I used to think about it that way too, where I would think, okay, like value investing, you look at a company, you figure out what its earnings are, what is it worth, and you buy it below that price. And maybe the same thing for crypto as well. And then there's the other side, the technical analysts, the quants, who are saying buy above the 30-week moving average. And I think it's not that I think that I've come up with some third way. I think I actually just think that there is just a bigger picture, like a universal framework, which is just to say that no matter what your reasoning for thinking the asset is going to be worth something more in the future, you know, that you're only going to be right if the price moves to reflect that. So like, let's say that you think, you know, this lemonade stand is worth, you know, $10 per share and it's currently priced at $5 per share. Well, I can tell you from years of, you know, value investing in high school and doing it very poorly, I might add, that like no amount of like, you know, genius level analysis is going to help you if no one else ever just agrees with you. Like that company can be minting cash, right? But in order, there's like two ways that you're going to be right. Either everyone decides you're right and they start buying until the price moves from, you know, 5 to your valuation of 10, or there's something that grounds that value. So, you know, the company starts issuing a special dividend, or you know, the company gets bought out for $10 per share.
Or you hold the company until the end of time, you actually collect the DCF of the company.
No, right. Or well, no, but even then, like the DCF accrues to the company's bank account, and you're sitting there like, when am I going to get this money? You know, and I've, because, you know, this is again, so I like, I kind of think about this like philosophically sometimes, and I try to abstract out, and I'm like, okay, like what's the craziest thing? Like, what anchors price at all? Like, is this all in our heads? Like, why does this like lemonade stand, even if maybe my DCF is just like accurate, like I have access to the future, I can tell you every year's earnings, and I can tell you interest rates in the future, and I can perfectly peg it. Like, why, like, is it possible that the price could still not move to where it is? Like, is that, and the answer is absolutely. Like, and we see that all the time, right? So like when value investors talk about Mr. Market, like that's what we're saying, that's what people are saying, is that like prices on a short-term basis are not moving because of valuations. And when people say on a long-term basis they often hand wave that away. But the reason they do is because something grounds supply and demand. So for instance, if over 10 years, the price did not grow to reflect the valuation, the price just stayed constant, the company kept earning and growing, that company is going to get bought out because the private market is going to be able to take advantage of that
New buyer emerges.
Right. And so all the market is doing when the price is going up is it's reflecting that change in value, but it doesn't need to. And if you as an investor don't recognize that you can go for long periods without ever having your like theoretical value pan out, that's a risk, right? And we've seen the last decade that value investors got decimated, right? And it's not that they're all just suddenly bad analysts, right? It's just the market wasn't market just didn't see it their way. And
framework, why didn't the value perspective work in the last 10 years? What like shouldn't I assume those, I mean, did those businesses have fundamentals that decayed and therefore underperformed their kind of forecasts, or private equity buyers or this grounding buyer didn't emerge to fill the gap?
Yeah, it's so hard to say, right? Because so, you know, people like Cliff Asness at AQR, they really dig into this thing. It's called a value factor, where you buy cheap companies. And there's a lot of that discussion where, you know, the intent there is to buy companies that people are really down on. They look like they're decaying, but they're overreacting. So they're actually worth more. And over like multiple decades, that seems to do really well. But in the last, well, actually, but interestingly, from like 2000 to 2006, it destroyed the market. It did incredibly well. And then from 2006 till now, it has burned money. And it's like, it's fascinating too, because I remember in high school, I used to be enamored with all these guys, and there truly is talent. Like when Michael Burry, like those kinds of investors who are just incredibly talented, right? But you have to put it into context. So like Michael Burry is investing in 2005. Well, guess what? Value investing works in 2005. Those stocks are moving. And so he showed incredible talent. He probably outperformed the value factor, which is alpha, right? But like those stocks, like they moved in an environment where the market was flowing to the value narrative, right? So like that's that environment. In the last, 10, 15 years, we haven't seen that. And I don't know, maybe Michael Burry's pivoted and he's adapted to that environment as well. But like what we've seen in the last 15 years is if you buy an index of low price to earnings companies, you're basically like tracking the market. Whereas if you bought like a momentum fund, you trounced everyone, right? And I don't think it's because value is broken or momentum rules the world. It's because like the way that any factor works, any fundamental thesis, if you think your business is worth more, you can only be right if like there are money flows that move the price to reflect that you're right. When that can be an event, an arbitrage where someone says like a private buyer comes in and literally buys the whole thing, and that's the money flow, is the purchasing of the company, right? Or that can be that the market's like recognizing that value more and over time. And so I tend to, anyways, to bring it back, I tend to think that these models, they just kind of subsume under one big umbrella. I think the fundamental analysts are over a long time horizon. They're looking at flows that dominate. So like these things like the triple halving and things like that, they're like 18 months was my time horizon. I think it's a longer term catalyst, but it's like, these fundamental analysts are looking over a 5 year. You'll often hear people be like, you have to have a 5 year time horizon, like 5 to 10 year holds, right? I'm like 5 to 10 year holds, but it makes sense. Like over that time horizon, either the market is going to just start agreeing with you, you're going to be wrong, or like a private buyer will emerge to make you right. And so if you're a fundamental analyst, that's the time frame to work it on,
Let's before we should move on to Ethereum, but why do you think it is that in the I don't know, the buyer to set the new price or to recognize value hasn't emerged? Like if it's one consistent, if it's not just kind of investors moving from one temperament to another, like what's the, I guess this is a very large question. It's been debated to death in investment.
Yeah, it's
do you have a theory on why value is not working?
Yeah, I mean, first of all, I would actually say that it's potentially starting to work in the last like 6 months. So why was it not working and why is it working? I mean, that's a bigger question that I have expertise on. So just caveat. But from what I can tell, I think that interest rates and the Fed and the macro environment has a big part of it. And so if you have interest rates at 1%, you can afford to pay for earnings that are farther and farther out. Value stocks often get most of their value from the next 5 years of earnings, versus something like a Tesla, where it's getting its earnings from much, much farther out. So if you're willing to, if you're comparing like, Hershey's chocolate company to Tesla, and your valuation model is saying like the next 5 years is what really matters because there's high interest rates, then, Hershey's chocolate company is going to be worth a lot more. But if you're saying, hey, no, interest rates are so low that we're going to give value to what happens 10, 20 years out, well, now Tesla is really going to have that exponential growth, right? And so that gives Tesla a huge edge. And I think we saw that in the like 2015 to 2020 timeframe. And then now we're seeing stimulus in inflation-related concerns and interest rates potentially rising, and we're seeing value make a comeback. Is that causal? Like, I'm not sure. And honestly, like I get that take from listening to a lot of people who are smarter than me, but that's my understanding right now.
Awesome. Okay, let's talk about your paper. Instead of me trying to summarize it, why don't you give the kind of 2-minute summary of what were you trying to say in this paper, and what got you so excited that you wrote a 79-page report on Ethereum?
Yeah, so I got interested in crypto a year ago through Bitcoin, started to learn about Ethereum, started to understand the platform was very big. And then only in the last like 2 or 3 months, I think, I started to learn about EIP1559 and proof of stake, which are 2 coming upgrades to the Ethereum network. And that really has changed, I think, the investment case. And so, big picture, what I realized was that I think that a lot of how investors are looking at Ethereum is just a riskier version of Bitcoin, or Bitcoin's little brother. But especially moving forward, EIP1559 and proof of stake create like a fundamental difference. They are going to be, blockchain technologies that operate completely differently. They were already very different, but after that point, not just in name, but it'll also be in like the way that the network is secured, the way that the platform operates. And so I was like, wait, this change is going to be big. Let me look into this. And then I realized it's not just a change in the story, but it's a change in how the buying and selling of Ethereum and Bitcoin is going to work. And so my thesis boils down to, I think that in the next 18 months, we're going to see Ethereum becoming dramatically more illiquid. It's going to be harder to buy or sell without affecting the price. And that's going to be a change we're going to see in Ethereum that we're not going to see in Bitcoin. I think we're going to see a huge on-ramp of demand. I think that's going to be the kind of demand that we're going to see in this cycle wasn't even possible in the last cycle. Just the technology and the access has improved. I think in the next 18 months, there's going to be a major catalyst. And so we'll get into this a little bit, but I talk about how these upgrades, EIP1559 and proof of stake, are actually like structural shift in demand and supply flows. And that will kick off the price and kind of get it off the ground. And then I argue that price leads people to look into these technologies, and that when they do, unlike the last cycle where mostly people were looking at Ethereum and seeing the initial coin offering craze, I think a lot of people will come back and say, hey, wait, we're back doing this again. Like, what's this about? And they'll say, oh, wait a second. There's something real here. We have businesses being built on the network. We have exchanges. We have lending. We have yields. So unlike buying Bitcoin, which a lot of people were willing to buy Bitcoin for no yield, but now I can get a store of value and get a yield. So that's intuitively a more common investment case. So I think that all of that is going to combine to just create a much more powerful dynamic in the next 18 months than people are used to. And the reason I started getting really passionate about it is because I started to realize that everyone in the space, including many of the Ethereum experts, they're experts in the technology. So they would talk about how Ethereum is different, and they would write long articles about the technology and what makes it unique. But then everything came back to a Bitcoin analogy. Every analysis of where price could go and why was all based around Bitcoin. And as I pointed out, I think a lot of these dynamics are going to be unique to Ethereum and not Bitcoin. And so I think the future will break with the past. This is not uncommon with disruptive technologies. And I was like, well, that's silly. Like, so much respect for the technology and the analysis that these experts provide. But I think from an investment perspective, I think a lot of the analysis got a little lazy comparing to Bitcoin. And so I thought, hey, maybe I can make the case that this will change and that will be more dramatic than anyone's really expecting.
Is that true even with the kind of people in the Ethereum community like Justin Drake and Bankless people and Anthony Sassano? I feel like their analysis are pretty much grounded in the inherent merits of Ethereum.
Yeah, and I should clarify. So yeah, every name you mentioned, Justin Drake is who I based all of all the numbers in my case was based on his work. Anthony Sassano, they're incredibly bullish. They are 100%. They have their finger on the pulse. They know that Ethereum is not Bitcoin. They know that it's going to be worth a lot more than people anticipate. So it's a minor critique, but it matters because at the end of a lot of these articles, and I don't want to pick out any names. So I think Anthony reached out to me and he was like, hey, I actually have a higher price target than you said I had. And I was like, oh, so, I don't want to say that they're all like pessimists. It's just, I saw, a lot of people would look at the price action in the last cycle and they would say, oh, like in 2017, Ethereum moved 20% more than Bitcoin. And I think based on this Bitcoin valuation model, Bitcoin's going to go up 5x from here. So Ethereum will go up more.
If I were to rephrase, it was like everyone, the level one easy way or maybe lazy way to kind of do the price forecast this cycle is to analogize from prior cycles and vis-a-vis Bitcoin, whereas you're doing more of a kind of fundamental and people talk about first based analysis based on what is the underlying mechanics that's going to happen in the next 18 months for Ethereum supply, Ether supply, and how is that also based on some prior experience with Bitcoin halving going to affect the Ethereum price. Since these things that are happening to Ethereum in these two major changes, the EIP1559 and the merge, have never happened in history in crypto. So there's no way to analogize their effect.
Exactly.
Right.
Yeah. And the analogy is what I was thinking. I was like, man, they're so, their life is Ethereum. And then I listened to the Bankless like ultra bull case for Ethereum, and the highest price target was 20,000. And I was like, that's below my base case. You know what I mean? Like I'm like, maybe I'm just insane. I was like, who am I to say that they're wrong? But it would be a real shame if, I was thinking to myself at the time, I was like, it would be a real shame if Bankless like sold their Ethereum at 20,000 and it ran to like 150,000 because they knew, if anyone were to know,
bullish camp out there.
Yeah,
right?
exactly. If anyone were to know this was going to happen, it would be them. And again, it's not that they got any of the analysis wrong. Like they're on it, like their fingers on the pulse, right? Like they know. It's just when it comes to like the next 18 months, there are these just unique attributes that I think all these analogies are going to break down. And so if you have these, it's a cycle, you have to sell at the top of the crypto cycle because it's going to go down because every 4 years it goes up and then it goes down. Well, what happens when that cycle breaks and you sell and it goes up? And then everyone gets left behind, and it's part of my thesis where it's like, if it breaks and it goes from 20,000, maybe it goes down a little and it breaks out of 40,000, everyone FOMOs back in. Like that's how crazy things happen, And but do you really want to have missed that much of the move? Anyways, that's kind of what the impetus was like, let's get people who kind of have done the work. Let's get them like the outcome they deserve instead of having them cash out like 7x before the peak, is at least per my thesis.
I agree. And if I were to kind of help people understand your style of analysis here, once again, I think it's very interesting that it's not a fundamental based analysis in the sense that Ethereum will ship a new feature and this feature will be worth, will capture 1% of the banking market. Like Arthur Hayes, for example, wrote a great piece valuing kind of the very top down opportunity for Ethereum in the context of DeFi and capturing the financial markets. And there he's like, if $3 trillion financial market plus auditing market, you capture 1% of that at the same multiple, Ethereum should be worth $40,000. Very clean argument, right? But also a very, very long-term argument. You have to believe a bunch of things about adoption and software actually taking on these roles. And I enjoyed that piece a lot, and I talk about it all the time. You're not saying any of that. You're like, fine, whatever. You don't have to believe in that one way or the other. Nor are you looking at charts and saying, here's the line, here's the Bollinger Band. You're not saying any of that. Your argument is purely around the supply and dynamics of Ethereum and these specific two changes coming up that will dramatically change those characteristics. It would be like if I'm an Apple investor, or we're Apple investors, and you're like, I don't care about the next iPhone. I don't care about the next iPad or the VR goggles, whatever. And I don't look at the charts. But Apple has this new mechanic with its share issuance where... Well,
that's actually, okay. That's a better analogy than you'd think, because so you've seen what the price of, but so you've seen what the price of Apple has done in the past, 5 years, 10 years, I think. Well, look back to when Tim Cook came over. Apple's cash flows were insane. Steve Jobs, was no longer CEO. Everyone was worried about the product. And a lot of people were skeptical because they were like, well, what product is Apple going to ship? But there were some investors who were like, wait a second. Tim Cook is going to take all this cash, and his philosophy is to do share buybacks. He's going to take, I don't even know what the numbers are, like $100 billion of cash.
Dollars of balance sheet to work with.
Right. And he's going to just buy back stock. Well,
that's right.
So that has a theoretical effect on like earnings per share and all this stuff, but it also has the effect of just buying shares of the company, right? And I'm not arguing that in the short term that was just like a Kickstarter, but I do think there were a lot of really astute investors who, for instance, when Warren Buffett comes into Apple stock, I don't think he's arguing that he's suddenly a technology guru who can see that Apple's going to release AirPods, right? I think he looks at a huge buyback and he's like, that is structurally, Apple will be at a higher price in the future. And so if I buy it now, and again, I don't want to give the impression that my Ethereum thesis has anything to do with a Warren Buffett philosophy, but just to show you, like, this isn't a unique, like, I'm not coming up with a way of looking at assets that
this happens in the stock market all the time, right?
Exactly. This is not a one-time thing or the first time this argument's been made.
But Ethereum is because it's so programmable, it can, like, its equivalent to a stock is the number of shares outstanding. Like, there are things that can happen, and Ethereum's equivalent is the total ETH supply, right?
Absolutely.
And there are things like with EIP1559 and the merge, like crazy shit happens to the supply. It will be like I don't know. It would be like Apple saying, we have this new model where I don't know, every employee we have right now issues a lot of stock to employees as stock options. Instead of cashing out those stock options, they will be burned instead. So they will never enter the
right.
pool. Like,
right. Exactly.
That level of mechanic. And when you apply that level of mechanic to a thing where the price is heavily, influenced by the supply mechanics, it has dramatic consequences completely independent of the technology fundamentals and adoption.
Absolutely.
Things like that.
Yeah, no, the programmability of Ethereum, it makes everything, it accentuates the effect completely, right? So yeah, you're absolutely right. Like, if they're buying back shares, like, it's an effect, but it's mostly going to be more of that theoretical effect where it's going to raise earnings per share and people are going to, agree that that's worth something instead of a supply demand dynamic. I mean, there's something to that, but in the case of Ethereum, you're talking about right now, there's 12% of Ethereum that's just literally locked or staked. No one can touch 12% of it. So that's it's the equivalent of like an insider coming in and owning 12% of it. And now I'm telling you, like, that's going to burgeon up to like, we're going to have like 20, 30%, and it's just going to keep accelerating.
Right.
Yeah.
Let's go through to the next layer in your model. You call it a triple halving event for Ethereum. For folks who don't know what halvings are and the mechanics of how to think through that in terms of price implications, would you kind of give an overview of what all that's about?
Yeah. So that. I call it the triple halving because I wanted to anchor it in something that I think a lot of at least cryptocurrency aware investors would know about. And so, but just for an audience that might not have it, so Bitcoin it uses a proof of work model for their blockchain, and what that means is they have miners, and the miners run computations on their computers, which is the work. And in return for doing that work, the miners receive issuance from the network. It's called block reward, and that's just new Bitcoin. The work they provide is important to Bitcoin network. It provides security. It allows them to validate transactions on the network. And so it's really crucial that they get this reward because it incentivizes them to do this service and provide security to the network. But Bitcoin, when you provide new issuance like this, that sounds like dilutive, right? So it sounds like there's just constant supply increasing. And that's true of circulating supply. So like, if there's 10 Bitcoin that are in the ecosystem, every day more Bitcoin are being given to miners, and that circulating supply is increasing. But Bitcoin has a programmable amount of total supply, and so the amount that can ever be mined is capped at 21 million. And so how do you have this dynamic where miners are being given new issuance? And the amount of circulating supply is increasing, but the total supply will never change. And the way that they do that is that every 4 years, the amount of new issuance that is given to these miners is cut in half. So again, that doesn't mean that there's half of the Bitcoin that used to exist
Just the issuance is reduced by half.
It's just the new issuance, right? And so it's a small part of.
This is why it approaches 21 million asymptotically. It doesn't keep going up, even though it's going up all the time.
Exactly. So maybe like the first, maybe you start with 10 million Bitcoin, and then after 4 years you're at 15 million, but then 4 more years you're only going up to 17 million. You're not going up by a constant amount. It's going to approach 21 million. And yeah, it's even the 4 years. It ends up being roughly 4 years, but it's based on the way transactions work. It's on the number of blocks in the blockchain. Rather than like the time, but it ends up being roughly 4 years. And so that dynamic is well known in the Bitcoin community to have caused a major spike in Bitcoin's price 3 times in the past, this being the 3rd time.
So the last time was May of 2020.
Yes, the most recent halving was May of 2020, and you can kind of look at the price of Bitcoin and what it did in the months that followed that. So a few points here. One is that this is the 3rd time. So it happened in 2012, where the halving event, and 3 months later, Bitcoin's price is dramatically higher. It happened in 2016. That caused the mania that in 2017 that I think was much more well publicized. And then it happened this year in 2020 as well. The other thing I'll point out is that in every single one of those episodes, it's not that the day of the halving, Bitcoin suddenly spiked, right? So I had this experience because, again, like I'm a little new to this, and I was like, oh, great, Bitcoin's halving event. This is going to be amazing. And I, went on my Robinhood and I was like, let's do this. I bought some Bitcoin. The day of the halving, I'm like, this is the most boring thing ever. Like,
you couldn't tell that.
Yeah. It was like such a letdown, honestly. I was like, this is not what I was hoping for. Everyone's telling me it's going to 10x, and it's like, Bitcoin's up like 3%. I'm like, okay, great. But that leaves something to be explained, right? So why is it that Bitcoin's not moving on that day, but everyone's attributing the halving event to Bitcoin's rise over the next year or two?
Before we get to that, why should halvings cause Bitcoin price to increase?
Yeah, so the story, because Bitcoin doesn't rise on that day, the story is that what a halving event really tells you is that Bitcoin is scarce. And so you can model the value of scarcity. So for instance, when people who are interested in buying gold, like physical gold, think about what they're buying. There's this thing called the stock to flow ratio. And stock means like how much gold is out there in the economy right now. And flow means how much is being mined every year. Okay. So, a scarce asset is going to have a higher ratio. I mean, the amount that's being mined is just a smaller part of the overall amount, right? And so that's a theoretical model to value gold. So you could say, like in 2020, Bitcoin's stock to flow ratio became higher than gold's. Right? And so everyone's like, well, gold has a $10 trillion market cap. Bitcoin has a higher stock to flow. This is why the halving works is a narrative that I've heard. This is why the halving works is because now it changes people's valuation models. It makes people think it's worth more. But that didn't sit well with me. And I think a lot of people it doesn't sit well with, because that should be priced in, right? Like I can look ahead and I can know the halving is going to happen. Yeah. And so a lot of people, and this, again, it's not an original idea that I'm having. A lot of people in Bitcoin will agree with this. They'll say, no. Like that is a narrative, but also the Bitcoin halving can't be priced in. It's a saying that people in Bitcoin maximalists will say a lot. And I used to just be like, what does that even mean? Anything can be priced in. You can price in any information, right? But I came to the conclusion, I think, that they're onto something. And the way that works is I started to look at Bitcoin miners. So these Bitcoin miners, they run these computers. They have expensive graphics cards. They use a lot of electricity, generate a lot of heat, and in return, they get this Bitcoin. Well, guess what? They have to pay for the air conditioning. They have to pay for the graphics card. After each halving event, it becomes twice as hard to mine Bitcoin. So they need to buy twice their equipment, and I'm simplifying here, but the idea is they have a lot of fixed expenses. And if Bitcoin's price goes down or goes up, it doesn't change the fact that they have employees with salaries to pay. So they have to sell a lot of their Bitcoin. And they're doing this constantly. And so Justin Drake, in his spreadsheet, he modeled the profit margins of a Bitcoin miner at 5%, right? And I was like, well, that's pretty aggressive. That seems pretty low to me. I mean, maybe it's like there's, businesses out there with
5%, and then you get a halving. Aren't you out of business?
Yeah. So I was kind of confused. I was like, this doesn't make any sense. So I started. So first of all, my analysis, because I was like, this is too much to include in my report. My analysis just took Justin Drake's assumption and ran with it. Right. I didn't address this, like question, but I will say, like on my part, I looked into this just to see if it was like a valid assumption.
Yeah.
And I think he's onto something. So I looked at Riot Blockchain. It's a publicly traded Bitcoin mining company. And when Bitcoin started running up, it was kind of famous because Riot was going even faster, because Riot's like $100 million company, and Bitcoin was at the time was like $200 billion market cap. So if Bitcoin went up 5 times, Riot went up 30 times, something insane like that. So I started looking at Riot Blockchain's SEC filings because they have publicly available information. And let me tell you, Bitcoin miners are horrible business models. Terrible. The entire annual report is them just explaining how they recently bought a new computer and they're sold their old computer, but they're going to have to buy a new computer soon because their current computers are not good enough for the next halving. Like, it's terrible. Like, they're in their income statement, I just couldn't see any profit. Like, their operating costs, like I genuinely don't, I had to dig into the accounting, but I don't understand how they're not all like going bankrupt, right? I think it has to do with the fact that there's an inflection point. There has to be like at the peak of the cycle has to keep them afloat. I'm guessing. But like, if you just look at like the 2020 and 2019, for instance, like their income statements, they're just burning money. So like, maybe Bitcoin's price has risen. So maybe in 2021, they'll finally get profitable because they'll have some, it's called operating leverage if their costs are fixed.
Sure.
But it's more complicated than that, because when the halving happens, they have to make sure that they maintain the amount of Bitcoin that they're actually mining. And so when the halving happens, they have to like go and buy more computers. And it's been well publicized. There's a shortage of graphics cards. Like, these are not easy things to get their hands on.
Yeah, I mean, get ASICs for Bitcoin mining, but like, given a less than 10% margin, how can, if Bitcoin halves, their revenue, their top line comes down by half, right?
Yeah. So if Bitcoin halves, their top line, like from that point, would come down by half. But the Bitcoin is predictable, right? So like this halving it, they can forecast their revenue, they can forecast their expenses. But you're right to think that, man, if 1 year the halving happened and Bitcoin's price did not go up, they would be screwed, because they would have to invest in twice as much mining equipment to get the same revenue, right? And so if they're running this thin margins now, they would not be able to really sustain a business on it.
Exactly.
Yeah. So there would still be, it's not that mining is not something
I guess it'd be interesting
do, it's just
to look at profit margins over a full cycle to see like what the blended profit margin would be.
Yeah. And I imagine, they have to be higher than 5% over a full cycle. But the reason I didn't is because I actually don't really care about the profit margins over a huge cycle, because I want to know how much Bitcoin are miners selling before the halving.
Okay.
I want to know before, because if after the halving they are holding onto the Bitcoin as the price rises and recognizing tons of like revenue, and maybe at the top they sell, like that doesn't affect my argument. I'm looking at the next from here to the top, like what's the selling pressure that we're going to see, right? And so if that, I genuinely do think that at the top there's probably selling pressure from miners that have managed to like hold as much as they can avoid selling, and they're dumping it at the top as prices turn down. So that's probably part of the dynamic. And saying that the miner sell pressure gets cut in half is a simplification, right? But it works very well for that time period that we care about, which is that the halving event happens, and then 6 months later, the price is much higher. Why? Right? Explaining why it crashes afterwards involves a little more nuances about what the miners are doing. But anyways, I thought it was a good operating assumption to kind of just look at for that little time period that I wanted to focus on. Does that make sense?
Sure. So what is the key takeaway here? I guess when reading your paper, the key takeaway is because they have to sell.
Yeah, sorry.
Yeah.
Okay. So yeah, so the key takeaway is that miners have to sell a huge fraction of their Bitcoin that they're mining,
Roughly,
and that they have to do this. Sorry.
Roughly on what order, like percentage wise, half, like more than half?
Yeah. So if the profit margin and the profit margin includes all the expenses, includes taxes, but they have to sell 95%, right, on this 5% profit margin assumption.
This is a form of inelastic sell pressure that is just constant, right, in Bitcoin ecosystem.
Yeah, it's price insensitive. So they have to deal with their expenses. And if anything, like they need to raise cash before the halving to deal with future expenses so that they can be hodling through the halving, right? So like it's exactly, they have to sell a lot of Bitcoin before in 2019 and approaching 2020. And yeah, they're selling 95% of that issuance. Well, when a halving event happens, that total amount that they're selling at the very least has to decline by 50%.
Right.
And I think it could be that it declines by more if the miners are more profitable at higher prices. I don't know. That requires a more detailed model, but
so to
the idea there is exactly to bring it back. It's just if miners are selling a fixed amount before and they're selling half that after, there's reduced price insensitive selling. And that is kind of a tailwind on price. It doesn't mean that price has to go up, right? If an equal and opposite amount of selling happened, so if we found out that the US was banning Bitcoin and everyone started to rush to the exits, Bitcoin's price would crash after the halving, because the halving is not a big enough change in sell pressure to account for that kind of outflow, right? But if things are roughly the same, if nothing has really changed in that 3-month period, then that price is going to rise because the demand is going to stay roughly the same. The supply is going to stay roughly the same, except this little bit of price insensitive selling that was constant is going to have reduced. And now that amount of buying is going to be equally constant. And so if on any random day, the amount of selling just randomly declines by a little bit, the price is going to rise. So it's not going to rise every single day, but there's an edge that it will. If there's random variation in the amount of supply, but there's a fixed amount of supply demand dislocation, the price is going to rise gradually, and that'll happen until the price gets high enough that a new run rate supply that is equivalent to the miners selling appears just from the market, right? So it's not that it's going to rise forever, but it's at some point it'll get high enough that any investor at that price will be like now's a good time to sell, and they'll just emerge and create supply at kind of a run rate.
Right. So the key thing here is you are looking at, your analysis is focusing on the inelastic sources in the supply of Bitcoin, and then later on, using this to reason about Ethereum, because there are mechanisms, algorithmic mechanisms determining these dynamics. Prior to May of 2020, the block, each block reward for Bitcoin was 13 Bitcoin when you discover it for a block, and a Bitcoin miner would be they found the block, they get these 13 BTCs, and they would sell 90% of it. And that's the day-to-day operations of the business because they have to pay for their staff, right? Exactly. After May 2020, this gets halved to 6.5? It was about 12.5. So it got halved to 6.25, which is the current BTC block reward per block. And now they only get half as much, and yeah, they still have to sell it. But now the sell pressure has been reduced, roughly speaking, by half.
Right.
This is just it's almost like a ticking clock in the background. This is a tiny percent, less than 1% of the actual.
Yeah. Oh, it's tiny. Yeah.
Yeah. This is a tiny percent, but it basically soaks up. I mean, it changes over time. It accumulates and kind of soaks up the marginal buyer and seller.
Yeah, and if I can go back, so I used an example in my paper that I think really illustrates, because a lot of people go, well, it's 1%. Why is 1% such a big deal? Right? Yeah. And so in my report, I talk about something I call the Ipo Lock-Up Effect. Yeah. And that is where if there's a new IPO, let's say a technology company, And a lot of new insiders are millionaires now. And they're not professional investors. They don't know if their stock's going to go up or down in the next 10 years, but they're now newly millionaires. So they have to sell. And they have this maybe huge amount of stock, maybe like, 30%, 20% of the float is in these with these insiders. And so they start selling, and it's forced selling. And these flows are much bigger than the Bitcoin halvings selling, but they're forced to sell it because they don't care about the prices. They just want to get their fortune, right? So I talk about how when they do that, that can't be priced in. The price of that technology company or whatever is having that IPO lockup period, the day after insiders are able to sell, there is now selling pressure that doesn't care how low the price goes. And so the price will fall on that day. And if the price falls before then, in order to kind of price that in, then it'll just fall even more, right?
Because these people got their stocks at such a low cost basis. To them, this doesn't matter.
And they're rich. Exactly. They're not looking at it like, is this a good investment? I valued the company. They're like employees, and they just got rich.
Yeah.
And VCs. Yeah. And they're like, look, if it falls, like if I'm getting a 10% less, like I just want to secure, this is my retirement now. Like, you know what I mean? Let's not mess with
90% of my net worth is in this stock. I have to do it.
Right. I have to, they're not messing around. Like they're selling, right? So, okay. So that is price insensitive selling, and it moves the price of these IPOs down. That cannot be priced in. But notice, Bitcoin is not in a perpetual state of having its price go down, right? These miners are selling constantly, but its price is not constantly going down. So how does the analogy work? And my point is, yes, the Bitcoin miner selling is a small part of supply, but at the same time, because it's so consistent, it's perpetual. It's like this IPO lockup is never ending for Bitcoin, right?
Micro IPO lockups every day.
Right, exactly. And it leads the price to reflect kind of an equilibrium between supply and demand, where at whatever price Bitcoin is before the halving, sure, there's maybe 0.5% or 1% of the volume that is this like IPO lockup selling that would kind of reduce the price. But wherever that price is, there has to be an equal and opposite demand. There has to be price insensitive buying, right? And so I talk about this later in my report. Like, what does that look like? Well, it looks like companies allowing you to automatically have recurring payments to buy Bitcoin no matter what. It looks like people stacking Bitcoin and saying like, they're going to hodl for life. Never sell. I put 10% of my paycheck every week into Bitcoin. That's what that looks. It's price insensitive. I'm buying no matter what. And the idea is the reason Bitcoin's price can just not fall constantly in the face of the selling pressure is because at that price, there is price insensitive buying. And that's the best kind of a buyer. Like that's the kind of buyer that you see in a mania, right? They're just not looking. The reason I'm buying this is because I think it's going to go up. I don't care about the details of what I'm buying. It's automated. I'm not looking at it, buying it for like whatever reasons I have that are price insensitive. And when the price insensitive selling reduces, that price insensitive equal and opposite buying does not reduce. And again, it's powerful. And so even if it's a small percent, it's not just like fickle investors thinking about buying. These are, the most powerful buyers. And that's just going to overwhelm. People talk about weak hands to strong hands, transfer of Bitcoin. And that's what that is the strongest possible hands are the people who are able to counteract the miners selling. The miner selling is the weakest possible hands, right? And so suddenly half of the weakest possible hands reduce. Those strong hands are just going to eat through the like weak hands in the market that they used to be having this battle with the miners. Now they're going to eat through the kind of the market supply. And so, yes, it's just 1%, 0.5%, whatever that number is. But it is an incredibly powerful force over a longer time horizon when it has time to really act.
Just final point on this before we get to how this applies to Ethereum. I looked at the three halving points in time over in the context of Bitcoin's chart. And sure, it looks like Bitcoin rises afterwards. But normally, for at least the first two, it was basically halfway between a bull market. It was halfway already going up. How predictive do you think this is? Like, because Bitcoin macroscopically has been going up, if these lines you just drop them in random places, it seems like the chances of them going up afterwards is still pretty high.
Yeah, you're definitely right, but it is it is a little bit ridiculous that you can literally take the day of the halving, where the price is not doing anything too fancy usually, and then you could just go 3 months out, and you've trounced every other asset class, and you can do that for three different 3-month periods that are like separated by years.
Yeah.
And again, you're not cherry picking either, because you're saying, no, I'm following the algorithm that was preset. So in 2009, you knew what these 3-month periods were going to be to look at, so like we're looking at it in hindsight, but this isn't just cherry picking random dates to say, oh, like, Bitcoin went up here. It's like, no, the Bitcoin halving doesn't happen because of Bitcoin's price, right? Bitcoin halving happens because of a pre-programmed algorithm. So we look at this thing that has nothing to do with price, and we see these price effects. And so, yeah, I think it's pretty predictable. I mean, I think, we've also never had a major liquidation event in the 3 months after. If we, if COVID had happened 3 months after the Bitcoin halving, then Bitcoin would have fell, right? And so it is fortuitous that Bitcoin's halving has managed to escape those like major
could have
events.
Just been aligned to bull markets is my point. It's like 3 samples is still a little thin, right?
Yeah, absolutely. And that's why I get where it's like, these price insensitive buyers, they're going to move the price up, but that's assuming status quo with supply.
They're not the most powerful actors in the ecosystem.
No, and if a bunch of levered Bitcoin traders, have margin calls, like it's going to crash no matter how many people are stacking their Bitcoin, so, and that's why it's an edge, but it's not a certainty. It's absolutely not a certainty.
Okay, cool. So we've kind of covered why these halving events are important for Bitcoin. Basically, when you take off inelastic sell pressure, you create this new buy availability, and you can drive the price up over a multi-month period of time. Ethereum is a different blockchain with different kind of mechanisms guarding its supply. How does this apply to Ethereum?
Yeah, so right now, Ethereum is a proof of work blockchain as well, which means it has miners just like Bitcoin does. Yeah. And the miners receive issuance, which increases the circulating supply, just like Bitcoin does, right? But there's a few differences. Ethereum doesn't have a halving, and that's because Ethereum doesn't have a hard supply cap. So there's no, right now, at this moment, there's no algorithmic limit on how much Ethereum can exist in the world, which means so far Ethereum's miner issuance has actually been dilutive. It's not for Bitcoin, because they can look at the total supply that has not been mined, and they can argue that, look, the total amount never changed, just the circulating amount. But for Ethereum, it was actually dilutive, right? You're having new Ethereum. This could continue forever, and Bitcoiners bring this up all the time. And it's like a point well taken. Ethereum investors will argue that it's worth it for a variety of reasons, but it's not happening. And so that's the context, right? So then why did Ethereum rise so much in 2017? I basically think that Ethereum rose so much in 2017 for 2 reasons. One is just Bitcoin contagion. So the same reason that Bitcoin miners will go up when Bitcoin goes up, even though they're not profitable enough for their value to have literally gone up 10 times. If you forecasting future cash flows for a Bitcoin miner, Bitcoin's price is going to go through cycles. So you don't just multiply by 10, but the reason it's going up is because people are buying everything peripheral to Bitcoin. So Bitcoin goes up, Ethereum goes up, Chainlink goes up, every DeFi, altcoin, shitcoin is going up at the same time. And I think honestly that the best evidence that this is what is happening is that when you look at the correlations between 2 stocks in the same industry, you look at I don't know, what's a good example? Coke and Pepsi, or you see their correlations, and they're lower than Bitcoin and Ethereum. And if you know anything about Ethereum and Bitcoin, they are very different. They're not just 2 different soft drinks. You know what I mean? They're completely different assets. So the fact that they're more correlated, I think, tells you something about who is buying and what they're buying based on. And in 2017, that's what drove it. There was a Bitcoin cycle. Bitcoin was discovered by the media, and that's reflected in Google Trends searches, media appearances, and and near the end of the cycle, there was a little bit of a craze around initial coin offerings as well, where people started to take advantage of the fact that they could make money with this kind of Bitcoin contagion. But then when it crashed, that whole thing fell apart. So how is Ethereum different than Bitcoin is an interesting question, because so far it hasn't been treated differently. And so far there's been maybe good reason that it hasn't been treated differently, because even though it advertises smart contracts, it still has been a proof of work system, and it's had issuance. And so if so it's not going through a halving event. The only thing that really moves its price so far, and it's this correlated to Ethereum, this correlated to Bitcoin, is Bitcoin. So there's no, to this point, if you bought Ethereum and you thought Bitcoin was going to go down, then you were doing something that kind of contradicted itself. And this will change.
Those in the Ethereum ecosystem truly believe in the merits of Ethereum as opposed to
Absolutely.
Bitcoin, right? So they're saying they're just too small to really matter in terms of
exactly. I'm saying that, yeah, they believe it and they know it, and that knowledge is mispriced. So I think they'll be rewarded for it. But the data doesn't show that they are that their beliefs are being reflected in price.
Maybe until this week or two.
Well, yeah, absolutely. In the last week or two, things have been a little different. But
I agree. And generally, they're like, one is a higher beta version of the other.
Absolutely, exactly, and that's actually what this thesis is built on, because that will change. So I argue in the next 18 months, not only will the next 6 months, we'll see the change happen, but over the next 18 months, I think that the prices will reflect that Ethereum is not just a higher beta version of Bitcoin, that something is really going on here. So there's two changes. One is called EIP1559. And all that is a software update, basically. So the code that underlies the Ethereum blockchain is going to change the way that transaction fees work. So normally with a proof of work blockchain, like Bitcoin and Ethereum, transaction fees are paid. There's like a limited number of computers that are validating transactions. And so if you have, let's give an example. You have 100 computers that are validating transactions. You have 100,000 transactions that want to go through. How do you prioritize whose transactions get through, and how do you kind of like make the system efficient? So right now, these fees are being paid to the miners, and that allows both the miners to have an incentive to validate the transactions, and it also allows the system to kind of like adjudicate which transactions go through when and how to prioritize, right? So right now the transaction fees just go to the miners as issuance again, or actually not issuance, sorry, as it's just being paid from the people who are,
the users are paying in this case, not the
exactly. Sorry, not issuance, I should clarify. Yeah, but yeah, so it's being paid to the miners. But I guess what I went to say with that is, and the miners are selling that issue. It's issuance to miners. The miners are selling that just like they're selling the block reward. So it's not dilutive, but it's part of that sell pressure, is I guess what I was trying to get at. So with EIP1559, Ethereum is going to say, we're not doing that anymore. From now on, 70% of the transaction fees we're going to burn, which means we're literally deleting that from circulating supply. This would be the equivalent of just literally like setting 70% of transaction fees in dollars, like setting them on fire, right? And the effect of that is to reduce the circulating supply. That's really important because, as I've kind of brought up, Bitcoin is a hard cap, but its circulating supply is increasing. And that's just the same thing that's happening to gold, right? It's like, yeah, there might be a fixed amount of Bitcoin in the world, but there's a certain amount that investors own, and that amount is increasing. Yeah. With Ethereum, for the first time, we have a mechanism to decrease the amount of Ethereum that investors hold. So it's not just decreasing the total supply theoretically, it's actually decreasing the circulating supply. And that circulating supply is what forms the supply and demand dynamics around, well, any asset.
Supply in a moment in time, in the present.
Exactly. It's the supply right now, and not the future theoretical hard cap. We're talking about the supply right now, right? So that's huge. And it leads to the question of, so how big could this get? What does 70% of the fees mean? And Justin Drake's an Ethereum researcher, and he's been doing a lot of analysis based on the like rolling 365-day moving average of transaction fees to kind of get a sense for, okay, so like what kind of fee burn are we going to see? And based on his calculations, we're actually going to see a 2% net deflation in the circulating supply of Ethereum. So that means that every year the amount of Ethereum is going to decrease. The amount of Ethereum that's available to purchase and out in the market is going to decrease by 2%. And effectively, that creates a hard cap on the amount of Ethereum, right? So if enough is going to be burned every year that the supply is going to decrease, then that whatever the supply was at that moment, that's the peak supply. So that creates an effective hard cap. And I think I remember the estimate he put was 120 million Ether that will ever exist. But it's bigger than that. So when Bitcoin has a hard cap, that's 21 million, of which a significant percentage is not in the circulating supply. They're not saying 21 million exist currently that investors have and they could be buying and selling. They're saying that's like the amount that will ever future exist. When Justin Drake says we have a hard cap at 120 million, that means that's how much Ethereum is already out there. And that's the amount from which we're going to decrease. So the hard cap on Ethereum is going to have a much more dramatic impact on price because the circulating supply is shrinking. Whereas for Bitcoin, the circulating supply is actually expanding, right? And so whereas Bitcoin's trying to make a philosophical argument around monetary policy, Ethereum doesn't need to make a monetary. I mean, it is a monetary policy argument, right? But they don't need to make that argument. It will show up in supply and demand dynamics because when they say they have a hard cap, they also literally the amount of supply is capped in that point in time, right? So it's going to play out.
So if you CNBC a year in the future, what's going to happen is you just two charts side by side. You can literally see Bitcoin supply increasing. And on the other side, you can literally see on-chain metrics showing Ether supply decreasing. And that's just going to be like shown side by side.
Exactly. So you can talk about like, the monetary policy implications of an inflationary or deflationary economy. But, that's like a value investor who's saying this company is worth more than you think it is. I'm trying to convince you to buy it. Yeah. I don't think you need to go that far. I think you're going to see this chart and you're going to see supply literally decreasing. And there's just, as long as demand doesn't collapse with it, the price is going to go up. And the price is going to have to go up to create new supply. It's going to have to go up until it hits people's price targets. And they go, oh, okay, it's time to sell. And that's the supply that the market needs to satisfy demand. So that's one mechanism. And that's scheduled for July 14th, which is much more concrete. I think when I was writing this, it was like July maybe, but recently they announced July 14th, which is exciting. It's absolutely a risk. A lot of people ask, like, is there a risk? Like, this doesn't happen. I mean, absolutely. Like, I think the analogy I use in my paper is merger arbitrage risk. Like, if a company announces they're going to merge, like, there's always the risk with like the FTC in those situations. There are whole hedge funds devoted towards handicapping that risk, right? So, is there a risk that this is not going to go through? Of course, it's not. Nothing's 100%. Yeah. But I don't know if you noticed, but I don't think it's priced in. I think unlike a merger.
Let me ask another question. Like, can it be? Is this another thing that cannot be priced in?
Yeah, I think it's like that Ipo Lock-Up Effect, where right now you have that 70% that's going to be burned. Right now it's being sold, and that there's an equal and opposite demand. There's an equal opposite buyer that stabilizes Ether's price. So right now, like Ethereum's at like 3,500 or something. Well, guess what? Miners are getting 100% of transaction fees. They're selling some very large proportion of that. Now, they're going to be getting 70% less of those transaction fees. So they're not going to have that to sell in the future, right? And so that has to affect price. And it can't affect price now. I mean, it could affect price now by convincing you to buy it. Yeah. But even so, like the day after EIP1559 happens, there'll still be less people selling than there were the day before.
Sell pressure, regardless of the price, sell pressure has to be lower post 1559. just by
right. And again, we can contextualize. We're not saying all of the sell pressure is cut in half or something. I mean, it's
one kind of sell pressure.
It's one kind of sell pressure, and it represents a small fraction of the daily trading volume. But like I explained with the Bitcoin halving, I think it's going to be very significant. The other thing to notice, though, is that, and I'll get into this, but the 30% that remains, so there'll be this like 3 or 4 month period from July to November where that 30% goes to miners, and again, those miners are going to sell, right? But that changes even further with proof of stake. So I'll kind of get into explaining proof of stake, but I want to kind of put that out there that 30%, the incentives around it, the profit margins, the way that like the expenses that stakers have are very different than the expenses miners have. And so even that 30% it seems like there's a lot more selling than there actually will be. And that's reflected in Justin Drake's math. So it's not like I underestimated the math. I think 3 halvings is a good description of the decrease in sell pressure that we'll see. But it just is to say, it's not just that the fees are getting burned. It's a setup so that we're going to see that happen. And then 3 months later, when proof of stake happens, it's going to kind of accentuate that effect.
Okay, so your argument, basically, you have 2 catalysts that are used to build your argument that it's a triple halving event. And by triple halving event, you mean that whereas halving reduced it by half, the Ethereum, what's happening in the next 18 months for Ethereum is going to reduce this for Ethereum by 90%, right? So yeah. First one is this 1559, and that contributes to what, a third of the sensitivity?
Yeah, it's like a 30% reduction in sell pressure. So it's roughly like half. It's like half of a halving events effect, like a mini halving, you know. So it's like if there are 3 halvings, 0.5 of that comes from EIP1559, and 2.5 comes from proof of stake. Right? So yeah, and that's really fun to think about, because a lot of this like equal and opposite demand is going to eat into the supply. When I talk about that, like I'm talking about it from Bitcoin before it goes on to a halving, which means it's coming down from a cyclical peak, and there's a lot of overhead supply. Right now, Ethereum is pretty high, right? And so I wrote this in like a kind of speculative thread a few days ago, but I was saying like I could easily see us rising into July and then actually falling, like sell the news kind of into that event. That actually, a lot of people would say then that it was priced in, and I would say I don't think that's true. I think that we'll see that happen, and that will be the overhead supply. Like if I'm just gonna make up numbers here. Let's say we go up to 8,000, and July 14th comes around, and there's a big sell-off down to 6,000, right? So now there's a bunch of like potential supply where if the price goes from 6,000 to 7,000, people go, okay, let me get out while it's good. That's the kind of supply, though, that it is perfect for a halving event to kind of soak up, because you have these price insensitive buyers who are just like, give me, like, weak hands to strong hands, right? They'll just suck that up. And so it's going to be interesting that unlike a Bitcoin halving event, which usually happens at a cyclical bottom, and then kind of pushes the halving, like soaks through supply and it kind of unlocks the price. We are already at a pretty high point. And so I think the effect that this will have is more likely going to soak up like new supply that comes on from like a sell-off, a scare. I think I talked about how if everyone's price targets is from 10 to 20,000 or from 10 to 25,000, that's going to be where a lot of supply comes on. Because even people who like Ethereum, they'll be like, oh, but 15,000 is my target for this cycle. Yeah. And they sell, and that's them selling is what we're going to see soaked up. Whether it's not about narrative, it's just about like people who are buying Ethereum no matter what at any price are going to keep doing that, and it'll soak it up. So anyways, that's just an interesting aside.
Okay. Just as a side, I have about 20 minutes left before I have to run. So let's,
all right.
We've got plenty of time to cover it, but let's talk about the main meat of the thesis here, the transition to proof of stake. How does that affect kind of the sell pressure?
Yeah, so the transition to proof of stake is really important. This is where instead of using miners to secure the blockchain, you use stakers. And a staker means you buy your Ethereum, you have a computer, it can be just any simple, like low cost hardware, not like a Bitcoin miner. And you will run a client that puts up your Ethereum as like at risk. And in return for validating transactions and not attacking the network, you are given issuance. This is important because this has a few dynamics that are different. First of all, in order to participate, you have to own Ethereum, and the amount that is staked in each validator is 32 Ethereum. Right. So with prices where they are right now, that's a lot of money. You're talking about like $90,000 or something, insane. More than that, I don't know. But the point is, it's a lot of money, and it's incentive aligned with Ether. So whereas miners have an incentive to sell, stakers have an incentive for Ethereum's price to go up because they have to hold Ethereum, and they will very likely want to stake their issuance as well. There's no reason to sell it because they don't have the expenses that miners have. So their main expense will probably just be taxes. So Justin Drake modeled 50% profit margins. Pretty much that entire amount is just from taxes that they recognize. So when the profit margins improve, that will make the amount of Ethereum being sold dramatically reduce even further. And Justin Drake kind of models this out, but that's where I get the 90% reduction from. So it's, I think you're dropping from 22,000 Ether sold per day down to 15.7 from EIP1559. And then you drop from 15.7 to like 2.6 from proof of stake. And so that's the big drop.
I see. This remaining sell pressure is just to pay taxes?
Yeah, I mean, well, so it's supposed to model. So taxes is not likely that most people will have 50% taxes. That's pretty high. But the idea was to model, we're trying to model, most of it will be taxes, and then a little bit of it will just be people taking money off the table. Like if you are a staker and you don't want to literally restake 100% of your ETH, which I don't think we could expect that everyone will always restake all of their ETH, then they might sell some of that. And so we can't just aggressively assume that it's, I think a 50% profit margin is pretty reasonable.
Okay.
Yeah.
So this is, how do I get this? Like how, for Bitcoin, that pressure was around 1%. What does this constitute for the Ethereum ecosystem? This constant kind of background sell pressure?
Yeah, I wish I had better data for like daily volumes so that I could have like literally calculated that. It just would have helped with context. I'm not sure. I think some of my back of the envelope math, I thought it was like something like 1% or like 1.5% or something like that. But I don't want to just throw out numbers. I think the key way to contextualize it is that the profit margins in proof of work are going to be very similar. And the profit margins in proof of stake, when they reduce by 90%, whatever it is for Bitcoin, we're going to see 3 halvings worth of a decline. So I don't know, what percentage of the daily volume that is, but because I can see the effect on Bitcoin, I can see that the effect will be bigger with Ethereum. And again, here it looks like I'm using an analogy, but it's not a theoretical one. I'm looking at like the profit margins are, again, these structural flows. I know that we're seeing the same kind of structural flows on a higher magnitude. And so I don't think I'm just making a theoretical analogy of like, oh, Ethereum is like better than Bitcoin, so if Bitcoin goes up, Ethereum will go up. Like I'm saying, no, like the exact same sellers that are going to, not be selling in Ethereum as in Bitcoin, but they're going to do it on, orders of magnitude larger scale. So we should see a faster, more aggressive move.
Okay, so let's say we buy the logic up to this point, which is that there's going to be 2 software change events that are very, very material to the mechanics of who sells Ethereum on a set schedule, this EIP1559 and proof of stake. In the aggregate, it will reduce that like background sell pressure by 90%. How do you argue from that to your price target of $150,000 per ETH by 2023?
Yeah. So from there, from there, in a Bitcoin halving, a first part of the move is going to be the structural flows. But the last part of the move is narrative. And that's why you see it crash, right? Because if it was all these structural flows, when Bitcoin fell back down, you would expect that those flows would kind of like pick it up, right? And so how does Bitcoin crash so much? I mean, I think it's what prevents Bitcoin from crashing as much as, Ether crashing 95%. I definitely think the halving helps there, but I do think like it will crash that much because at some point, what's driving it up higher is just narrative adoption mania, people going, oh, this might be interesting, and starting to like become Bitcoin believers. And I think the same thing is going to happen with Ethereum. And so then I was asking myself, well, how do I ground that? And I think a lot of institutions have already started looking at Bitcoin and looking at Bitcoin pricing models. So what I did was I said, okay, I think as a base case, a lot of institutions I can just use a fundamental analysis kind of style to figure out where institutions will buy up until. Like, I think institutional buying could continue past this point, but I think at the very least, institutions that kind of wake up to Ethereum when the price starts rising, they'll look into this, and I think they'll discover that it should be worth at least 30 to 50,000. And to argue that, I start going through kind of an ensemble of different valuation models. So I look at stock to flow, which is just a Bitcoin analogy. And I show how if you look at the historical Ethereum to Bitcoin ratio, you look at stock to flow, and then you have these changes. Suddenly Ethereum has a negative stock to flow. That is to say, each year there's a negative flow, there's a deflation of the circulating supply. I argue that deserves a premium. And so I kind of show how, okay, if Ethereum is just being valued at the Bitcoin stock to flow, then based on Bitcoiner price targets that a lot of institutions have adopted, Ethereum could get to 28,000 this cycle. But if you give it a premium over 28,000, a 5 times premium over that gets you to 140,000. Now, wait, my base case is not 140,000, right? But I argue, well, okay, what if you gave it a 1 to 2 times premium? And that gets you from 30 to 60,000, right? That's right in line with my base case.
Yep.
And it also suggests...
What is your base case?
30 to 50,000.
30 to 50, okay.
Right? And it also suggests at runway for, okay, when the price is going up, there's more narrative adoption, people have more conviction, people like learn and get excited. And if you're trying to see what, like in my head, the analogy I like to use is as Tesla price rose, you can see how analysts started adding things to their models. They were like, initially it was like electric vehicles, and it was like batteries. Then it was robo-taxi. Like, that's a new thing of like, oh, we didn't think to add the robo-taxis to our DCF models, right?
Yeah, and it's, oh, they can sell a computer too. Yeah,
absolutely. So again, this is a flows analysis. And I'm looking into the future, and I'm like, look, I can make a strong case, I think, for that, like 30 to 50,000. But no one's just going to hard stop there. I think there's a very clear valuation runway for if institutions want to keep buying into this, they absolutely will be able to, and they'll be able to justify it. I also use other valuation models. So I talk about, Raoul Pal has kind of famously on Twitter, he released a Metcalfe's law based valuation model where he regressed Bitcoin's price against the amount of active addresses. And he looked at Ethereum's path on that progression. And he said Ethereum should be worth 20,000 this cycle because its path along the progression was exactly where Bitcoin was in 2017. And so I pointed out that, well, in the 4 months since he wrote that post, Ethereum has bridged the entire gap in active accounts with Bitcoin and actually surpassed it. And so, Bitcoin is right now worth 5 times what it was worth in its 2017 peak. Yeah. So if Ethereum has now bridged that full gap, it should be worth 5 times what it would be worth at its like analogous 2017 peak. So if Raoul Pal says that peak is 20,000, it should be worth 100,000 right there, right? And so again, do you need to be that aggressive? No, you could say base case 30 to 50,000, but there's that runway. So the narrative can drive price farther. Nice. Then so I'll stop there. My report, if you're interested, the report has like several other valuation models. I go through a discounted cash flow and I kind of get to similar conclusions. But I guess the last piece of it is just to say, you have to, in order to get, like, you can throw these numbers around, but I acknowledge that getting from 50,000 to 150,000 is $10 trillion of market cap. You can't just throw around, like, if it tripled last time, it'll triple again. You know, I get that there's a diminishing return issue when you get to this size. So that's where it becomes so important that I talk about this illiquidity dimension. So just very quickly, Ethereum has this dynamic where when you stake Ethereum, you can't remove it in order to receive your staking rewards, your yield. And so I think that with the yields being so high, more and more people will stake their Ethereum. And even if they don't stake it immediately, they'll get in line. So you have to enter the queue in order to stake your Ethereum. And that means you're not selling it, because as soon as you leave the line, you have to get to the back. And so that's going to create a supply sink where suddenly, if you're looking to buy Ethereum, you're not going to be able to buy it from people who bought it, decided to stake it, and look away for 10 years. It's way easier to
be like a retail invest. It's like the opposite of a lockup expiration. It's like, I already have liquid shares. Let me lock them up instead. Now they're locked up. It's like going the other way.
Yeah, and the psychology is so friendly to it because you're receiving yield, right? So like Bitcoin tries to build this hodl culture on this narrative of like, this is real money, have the psychological willpower, like don't sell. Ethereum says, no, do whatever you want. On a side note, I'm going to pay you 25% a year if you hold. So that's just economics, right?
Yeah. It's like on top of normal psychology, it's like, we'll pay you to hodl. Like,
yeah, exactly.
It's against.
It's hard to beat. And I argue it's like whatever effect we're seeing in Bitcoin, I honestly think that hodling and that supply liquidity is a huge part of why Bitcoin is able to achieve $1 trillion market cap. Right. But we're going to see that magnified in Ethereum. And you can quantify it. So you look at the Ethereum that's locked in DeFi and the Ethereum that's been staked. Right now, that's 12% of market cap, right? And I talk about how if you look at the amount that would be staked to get yields to drop to 7%, which again, like if yields are at like 15%, like nothing yields 15%. And hedge funds, you can arbitrage, you could short Ether to collect the yield. Like there are ways to get free 15% yields out of this if you want to. No one's just going to sit around and let that happen. So I don't see a world where
where's the spread in yield? Why is there a thing you can rush?
So let's say that in November the staking starts and there's 4.5 million stakers, and based on transaction fees, let's say it's a 20% yield, right? If you stake, and so interest rates right now, like the equity risk premium is like 5%. Like if you buy the S&P 500, you should not be expecting 20% returns, right? What you can do is you could buy Ether, stake it, and then you could go onto the futures markets and you could short Ether to cover your exposure. So now you don't have exposure to Ethereum's price, right?
I see.
But what you will get is you'll get your staking yield in Ether. Yep. You can get that staking yield, and that'll be a 25% yield, right? And so even if the price of Ether collapses, that's still going to be a substantial, like kind of free yield that you can arbitrage. And that yield is not small. Like in a world with 1.5% 10-year interest rates, like a 25% yield that a hedge fund can come in and do that. I think institutions are going to do this at size. I think it's going to be...
Will incentivize them to go in, buy Ether, stake it, and then short the futures, just as a trade, a risk parity trade.
I mean, and that's assuming they don't look into this thing and say, this is the real deal. I want to just be a long-term investor, which I think I talk about the narrative, I think could very well happen. But I think at the very least, short term, this is just free money lying around for a hedge fund with even a little bit of sophistication. And yeah, I can't imagine a world where the staking queue is not backed up tremendously until we get to reasonable yields. Like, when you get to 7%, maybe crypto is a little risky, like it deserves the premium. Okay. But for that to happen, 20% of the market cap has to be locked up in staking. And that's assuming that DeFi doesn't grow at all. But we've seen DeFi right now has like 9% of the market cap locked up. So if DeFi grows, which again, the price of Ethereum rising brings attention to this space. So expect it to grow. Scalability, we haven't talked about much, but that's going to come online. I expect DeFi to grow. And that's just going to cause more and more to be locked up. And so when I talk about it has 50,000, but it has this runway to 100,000, runway to 150,000. Sounds like $10 trillion of inflows, but with the incredible illiquidity, it could be more like 50 billion, $100 billion that moves that. And sure, that's a lot of money, but when we're talking about the kinds of like an ETF coming in could soak up like half of that, you know?
And since the price is set at the margin, you don't need inflows equivalent to the market cap increase, right?
No, you don't. Exactly. I just point that out because I think that's a misconception a lot of people have, where they go 16. I mean, how could it? Who has the money to buy 16 trillion, right? Exactly. And I agree. And I just say like, this is not like everyone's not going to be able to just sell at the price point where it's 16 trillion and get that in cash. That cash will not come from anywhere, right? But that doesn't mean the price can't get there, and that some people who hold liquid ether will be able to sell, or even if it's staked, that you at those prices you couldn't like go in and short futures and lock that price in for yourself. I think you absolutely will be able to.
If you had to critique your thesis, or if you had to think how it could fall apart, and 3 years down the track, I find you under a bridge and you're like, dude, what happened? You had this beautiful report. What I thought you were going to make it. And you're like, I didn't make it. This is what happened. What did you tell me?
Yeah. I think the real test for my thesis is going to be, I expect that when we hit that 10 to 25,000 range, there's going to be a lot of selling from people with a lot of conviction. People who believe in Ethereum are going to start selling, which is not what you want if you want to fuel a mania, right? So the question is, how much is that going to be? A lot of people are going to like see the top, right? And they're going to be like, okay, I have to sell. So, and that's going to happen. I think I would expect that to happen a full 12 months before my thesis is over. So I gave myself till January 2023 because I thought I need time for a lot of things to kind of happen. I need time for proof of stake to cement itself, for there to be no problems with it, for everything to be ironed out, for everyone with those 10 to 25,000 price targets to have either sold or decided to stay. And I think that if there's a world where we see a complete collapse, where we see a full cycle downturn by the end of Q1 2022, if we're back at 2,000 because it went up to 20,000 and it fell 90% or something, that's a lot of overhead supply. So it might be tough to get all the way back up to 150. Could we get back up to 30 to 50,000? My base case, I still think we can, especially if an ETF comes in, and I still think the illiquidity applies. But those real peak heights, it's going to depend a lot on how many people sell. And there's a bit of reflexivity to this, right? So I'm hoping to convince people not to sell, but also
your price is because of your paper, which is because of the price target.
It's markets are reflexive, right? And so you have to, the best thing I can do for my Ethereum investment is to convince other people that I'm right.
Right. But your base case of 30 to 50K is still based upon a fundamentals kind of style analysis, stock to flow. And you have to basically, other people have to agree with you and take on that framework and act on that framework, institutions specifically, right? So to the extent that they don't use such frameworks, or to the extent that you give, in your more bullish case, you give Ethereum a premium over the kind of comparable for Bitcoin over its time in address, for the same number of addresses. To the extent that maybe narratives such as, given that institutions and Michael Saylor and these guys are just getting comfort with Bitcoin. I mean, arguably Bitcoin could still have a premium over Ethereum just because it has proven more lindy and it's had more airtime in the public. Right. So there are other dynamics at play that can make the multipliers higher or lower than what you assume.
Absolutely. And the thing with valuation models is they're so sensitive to these subtle changes. It's like, what's a 3 times multiple? How's that so different than a 5 times multiple, right? But it changes. That's like the difference between my base case and the illiquid peak. And that's like trillions of dollars. So I completely agree with you. But the reason I don't think that premium will apply, again, is because I think there's so many sophisticated crypto investors who will just tell me, I'll be like, hey, so why the Bitcoin focus? And they'll be like, look, Ethereum can't scale. There's this fundamental issue. Ethereum cannot scale. And I think if we get scaling to really on board by the end of 2021, like there's going to be a full 12 months where my thesis is still like on the table, and there's just going to be like no fees, like no fees at all, right? And so I just think that kind of like explosive change is going to be noticed and demand a premium, especially with the yield. Like it just kind of it's a snowball, right? Like you're getting these yields for this explosive. Suddenly the scalability is like the dagger to the heart of like Ethereum's narrative, like for any investor for so long. And I just don't think that people know. Like I think that people outside of the space, like they look into it, they're like, this isn't going to scale, this can't really be. And there's just going to be empirical evidence, like one way or the other. Like maybe scaling fails, like this is a risk I'm taking, right? But if it succeeds, it's not going to be like a 2x. Like the roll-ups, they're trying to change it from 15 transactions per second to 2,000 to 3,000 transactions per second, right? So it's not subtle. So if it works,
and it's already shipped.
Like I think it will.
Roll-ups have de-risked. Yeah. Okay.
Yeah.
My last question. I really got to run, and thank you for taking the time to do this.
Of course.
How are you positioned for this thesis? Tell the audience your bags and how you constructed those bags.
Yeah, I mean, I got in with a small, my meager sum of money in April 2020. I kind of went all in as it moved up, and I think my average cost is like $300. So I was like, I got in a nice spot, and I just got conviction. I was like, this was early, and so I was like, this is it. This is going to work. I just think there's no point selling until I've seen my thesis out.
Okay, you got in 300 average, but now how have you levered up? Have you become more aggressive over the last 3 months?
I'm really wary of taxes. So it's like I can sell and I can take a short-term capital gains hit, which I think is about to expire. Although I don't know, I have to look at it. But yeah, I can sell and get a short-term capital gains hit, and then I can move to something like FLI and try to get like higher exposure. The worst thing that could happen to me is if I get like knocked out of my position, right? It's like I'm all in, and I think that's a tremendous amount of exposure. And I've been talking about on Twitter where I'm like,
all in means like, what percentage of your portfolio, liquid portfolio?
I think 97.5%.
Okay, what's the rest? Just curious.
Yeah, so I took like 2.5%, and I have certain like discrete catalysts in like uncorrelated opportunities that I think maybe I can like take a YOLO bet and I can outperform over like 3 months. If I can outperform Ether, I can create new purchasing power. So I have like, I think I've tweeted about this. Your
intent is to be 100% in, basically.
Oh, I want to be 100%. Where am I going to get the cash to buy more ETH? You know what I mean? And so I have like call options on uranium miners with like certain June catalysts. I'm like, okay, maybe if there's a sell-off in Ether because it starts to hit price targets and my uranium miner catalyst kicks in, like worst case, I lose like this 2% and I'm not sweating it. Best case, like that becomes like 10% of my portfolio, and that's like a meaningful amount of new Ether that I can buy. And it's uncorrelated again. So that's a nice benefit. But yeah, big picture, I just say like buy, hold, 18 months. Like I'm not touching it. I'm going to be in medicine residency. I'm not going to have time to look at the price of Ether day to day.
You're going to be between classes. I know. All right, Nikhil. This has been a fantastic chat. What's amazing is you make falsifiable predictions and you've laid out the case super clearly. Nothing obviously we talked about is financial advice.
No, definitely not.
This is us talking about our bags and our views. But let's chat again. When do you think would be a good time to touch base? To check in if the thesis
yeah, it'll be good to talk sometime around after EIP1559, maybe after proof of stake. We'll want to see how scalability is doing around then too. And especially at the beginning of proof of stake, like how many people have staked? Like I want to know, because it's up like 10% since I published my report. Like people are staking, so it's crazy.
Awesome. Great chat. Let's chat again after 1559, and really enjoyed the report. Everyone should follow your Squish on Twitter, Squish Chaos.
Yep.
I'll link it in the relevant sections. And yeah, all the great stuff is there, and we'll chat again next time.
It's been great talking to you.
All right. Ciao.